the next round of financing. There's such lockup periods that it doesn't really make sense anyway. So I think you have to plan for moderate levels of capital as you show milestones in your business progression, and you have to deliver value to your customers along those milestones.
Yeah, I used to have an old colleague who was fond of saying that things are never quite as bad as they look, nor never quite as good as they feel. And this whole dynamic in healthcare makes me think about that, because I actually think that markets that are difficult to raise money, that are difficult in the early days, it builds in many cases a more healthy environment to build a quality business. And you know, the antithesis to that today might be the cybersecurity sector. It's hard to find a growth sector that is more white hot than cybersecurity. And if you've got a decent business plan, a dozen good engineers, and a customer who will just say good things about your product, and even buy it and install it, you might get a $100 million valuation on the West Coast on a B round. And that sounds great, right? That looks nice, or it feels good. But the reality is that it is a remarkably crowded market as a result, because there are so many companies getting funded. It's so easy for new companies to get funding that if you go to one of the cyber tech conferences like I just did last week on the West Coast, and you go to 25 different company presentations, they all use exactly the same words. And it is remarkably difficult. Forget about figuring out who's going to be the winner. You can't even figure out who's doing anything different. So that feels good, and that there's lots of excitement, and I call it Happy Valley. I don't call it Silicon Valley. I call it Happy Valley. There's lots of everybody's happy and high fives, and what's your last round? I've done that, and that feels great. But I guarantee you, there's going to be lots of carnage, and lots of pain, and lots of loss of money, and a lot of good businesses. Ideas that get destroyed by bad competition. So I think one of the healthy things, excuse the pun, about starting a business in the healthcare sector is there are fewer investors because of the regulatory environment and all the complexity in healthcare. I think there are fewer investors that feel comfortable that they understand it well enough to invest at the early stage. And I think that in many ways is a good thing. I think it creates a healthier environment to start a business. If you get started, if you're able to raise that capital, that A round, that B round, build your business, there's a much higher probability that you'll be successful.
Yeah, I think we often see companies that go from 0 to 10 million in revenue, which is really hard to do, and then going from 10 to 20 is extremely hard to do, and then going from 20 to 100 million, where you are the category winner, and maybe you have an opportunity to go public, and you're in the crosshairs of all the strategic acquirers, is super rare. And so I think what we've seen, each one of these phases, you have to think about different things, different considerations when building that company. So really in phase one, it's about focus. So getting from 0 to 10, we see a lot of entrepreneurs that end up falling down because they try to do too many things at once. Try to go after too many different end markets, too many different use cases. But the ones we've seen that really nail it, they get one use case right, one type of buyer. They get the go-to-market model right, and they're really focused on that. And then when they get to 10 million in revenue from there, it's around expansion. So continuing to innovate, investing in specialization. You're going to have sales team focused on this market, and a different one focused on the kind of inside sales, higher velocity business. And then it's really all about people. And even from 20 to 100 million, you need top-notch, experienced management teams. And it's scary for the founders, because oftentimes they're a product-oriented founder. They wrote the initial code, but they need to realize that they're not going to be the guy to run the company as CEO and take it to 100 million in revenue, because they don't have a sales mindset. And so having the partner with the right capital provider, having the self-awareness to say we need to hire a top-notch CEO, VP of sales, product management, building the team around you, and putting in world-class best practices, that's what gets you to 100 million in revenue. And it's really, really hard. And then I think as you're going through all of these things along the way, you have to continue to innovate. Because a lot of times, if you don't innovate, you'll even get to 50, 60 million in revenue, but what's your second act, right? You've already penetrated that market, you haven't innovated, other competitors are coming up, inevitably that will happen. And so you have to continue investing in R&D, product management, more and more innovation, new markets over time. So that would be my takeaway.
How do you work with? Yeah, go ahead.
So at this pilot, I know for the investors.
Yeah, maybe I'll start with the B2B, B2C, and then I'll pass it down to the pilot. But my view on B2B versus B2C is pick one to start. So figure out, what are you building? Are you building an enterprise business platform, or are you building a consumer platform? And focus on one first. And then over time, as you really prove it out and get it going, then you can say, oh, you know what? We can actually just, reconfigure the thing. So now it works at the higher end of the enterprise market, or vice versa. If you start with B2B, over time you figure out, oh, the market's growing underneath. How do we then create a light version of that solution to then address the B2C market? But I'd say start with one first.
Yeah, I totally agree with Chris, and I'd say, and I don't think there's a right or wrong answer other than pick the path of least resistance, right? I mean, pick the one that's going to be easier to penetrate first, depending on what your product or service is. One might be easier than the other. On the pilot, I think I think it's always good to achieve. Early stage investors are milestone driven. We don't have profit and loss statements to look at and just losses, right? I mean, there's no revenues. All we have to look at is the quality of the team, the people, and have they achieved the milestones that team has told us they're going to achieve. It's all about the team and building credibility, right? And achieving those milestones builds your credibility, builds your value, builds your investability. So to the extent that you have a pilot, that increases your credibility. To the extent that that pilot customer is prepared to pay as opposed to just use it for free, that increases the credibility of your product, of your company, your value proposition, at the end of the day, of you as a leader. So I would say achieve as many of those milestones as you can on sweat equity or friends and family capital before you go out to talk with institutional investors. Right?
Yeah, I think they pretty well covered it, but I personally tend to lean towards B2C just because that's my personal business building mindset. I just think you can get bigger ticket sales, and that's just the way I'm oriented. But it's different based on the specific company and the nature of the market and so on. So I think Chris's answer about picking one is probably the right answer. To elaborate though more on the comment about the pilot piece, the capital raising is milestone driven, but I think the thing that's a little unfair right now is each individual set of investors has decided they're going to migrate a little bit later stage to try to minimize their risk. So now angel investors want some revenue all of a sudden where they didn't want it before, and now they want pilots where they didn't want that before. Then venture capital firms want visibility to profitability, and they didn't want that before, and so now everyone thinks that they're going to go a little bit later. Well, the reality is that actually creates opportunity for investors and for entrepreneurs, because the investors can see some unique opportunities down market to get more favorable valuations or more favorable terms. Also, the entrepreneurs have an opportunity to kind of prove their path and to force somebody to break from that mold. So there's not a perfect answer around the pilots, but I think you need to have somebody, some customer that's going to stand by you and make an investor excited, and that calling card, whether it's revenue or reference or whatever, really gets the investor across the hump.
I mean, in healthcare today, there's a ton of funny money, right? I mean, these guys can invest. Tom was saying, the difference between the first guy that comes to my door that talks about patient engagement and the 500th guy that comes to my door that talks about the same thing is how do you effectively clear that clutter, right? So there's been, to a degree, a damping effect that's been created because you've got a confluence of the providers who historically have not innovated, who are suddenly, under the gun of government, who are going to now change how they're going to get paid, which means they have to innovate and invest. Things that they've never historically have done before, because culturally they've not done it. Right? Similarly, the same dynamics is occurring at the payer side. Similarly, the same dynamics is occurring at the corporate side. When I say corporates, the GE Healthcare, the large, the Bergs, and so on and so forth, are now creating venture capital arms, corporate development arms of their own. And so you've got all this rush of money that's going into ideas, that's going to entrepreneurs, which creates these artificial valuations. And so right now, there's beginning to be more of a reality check, more scrutiny of the entrepreneur who's even coming to try to get angel investing. Who Harrison said, look, angel investors are now going to want companies that generate revenue. So if you could develop multiple pilot opportunities that have a clear path to convert to a paying customer, right? Then even if that paying customer is going to pay at a 75% discount or 50% discount at full freight, once it's to the market, that's a big sign. And that's critical. It's how do you get beyond the 1 or 2 or 3 pilots to show consistency across the board. I think I saw there was a question in the back.
Here's the microphone.
Oh, thank you. Yeah, so you talk about the B2B and B2C, so actually I have a lot of question about it. So maybe I think that B2B means like, huge market space and fierce competition, maybe less regulatory requirements, maybe less regulatory focus, but maybe it's easy to raise money, while the B2B means maybe it's stable, it's maybe high profitability. So how do you see these two gains, of difference? One maybe is with huge imagination, while the other maybe, the market space is relatively small, but maybe more stable.
Yeah, so we look at mostly B2B, but every now and then look at B2B stuff too, and some of our companies do both. And I characterize the B2B segment as longer sales cycles, bigger deals, more sophisticated product usually, and longer implementations. I mean, it's big enterprise software like Oracle and SAP and the big EMR systems out there like Epic, that's in Johns Hopkins Hospital now, and that takes years to implement. And then we've also looked at B2C opportunities around more of the wellness, so general wellness offerings, health tracking, making sure that you're eating right and working out and all those things, healthy lifestyle. And the allure of B2B for us really is why we do more of it is it's a bit more predictable. It does take longer. It takes more investment in product usually, but it's a bit more of a stable market versus B2C is much faster product cycles, meaning that if you don't continue to innovate, you're going to get left in the dust in a year's time because the products tend to be on average more lightweight and there tend to be more competitors that pop up faster. And not to say it's a bad market. I mean, there are plenty of investors that have made a lot of money on B2C markets, in healthcare, in a bunch of other verticals, Facebook, for instance. And you just have to take a little more risk. And I think my point earlier on innovation, you need an even more relentless focus on innovation in the B2C because things are just happening so fast. But if you get it right, it tends to be a bigger market opportunity with higher velocity purchase decisions because there are that many more consumers in the world versus businesses. And so it can be an equally, if not more attractive market. They're just totally different rhythms, if that makes sense.
So, I would echo everything that's been said. I will say, I think, certainly one of the things that the internet has disrupted beyond my comprehension even 10 years ago is the ability to distribute a product B2C around the globe with one click of a button. And in the last half a dozen years, being able to deploy the infrastructure to facilitate that on a pay-as-you-go basis on the backs of Amazon Web Services. And even a dozen years ago, you couldn't have done the first, even if you built the second. So I think that there is, and that has just, that's been a disruption in B2C that doesn't really have an equivalent on B2B. So I think there's pretty massive opportunities. I've been involved in 2 B2C companies that have been not healthcare related, both of which have been wild successes as an investment. One of which was a local company called Savano, which sold cell phones online to consumers. It was the first place you could go online and buy a cell phone, any cell phone you wanted, and provision any service you wanted, whether it was AT&T or Verizon, on that site, and have the phone the next day. And we were actually number 1 on the Inc. 500 list, and it was 2004. And it was Goldman Sachs IPO. They called the unicorn.
Do you expect to see kind of like one big EMR taking over and creating that interoperability, or is it going to be a lot of third-party providers kind of helping to integrate all of the different EMRs available and trying to integrate some of these innovations, like we see things like Oscar Health or newer types of insurance or health systems integrating telemedicine, or even things like wearable devices, all of these very consumer-based new technologies. How are those going to eventually get integrated into the electronic medical record and also contribute to interoperability, like what the kind of end system or the vision after the next couple of years is going to look like for software?
That's a tough question. If I have the answer to that, I would probably be making a lot of money right now. Yeah. I can tell you this, that the government managing it is not the right way to go, and that it's going to be a path fraught with peril and a lot of issues along the way. I thought that more of a consumer-driven healthcare model where you get to more rational pricing would have been a better way to go, but I don't have that influence, and my partner's father didn't win, so when he ran for a recent election. But the point is that I think what we should do from a business perspective is try to take advantage of some of that inefficiency to create opportunity. And I guess where I see that opportunity is in trying to have a direct relationship with the patient, and by having that direct relationship with the patient, coordinating care for them, and then getting best-in-class technology to connect in with that centralized point that you create. For example, we have a home care company. We have 7-year-long patients. We focus on then connecting in technology to preemptively anticipate health issues with them to avoid hospitalization. So it's more like down on the ground, good care, doing the right thing for patients, and actually trying to impact the outcomes.
Yeah, it is a tough question. I guess my crack at it would be that, I think that kind of by definition, the way innovation works, it is like a democracy, right? It happens in pockets and by individuals. And I don't think the government, and certainly none of us, are in a position to have some grand vision and drive to that. I think that it has to be more fluid and living, and that there's just so much room to innovate in healthcare relative to other industries. Just some of the very basics that, again, back to health, when you go to the doctor's office. When was the last time anybody had a surgical procedure and got bills? I mean, you take your car, you take your car to the Alley dealership, do you get a bill from Goodyear for the tires? and from the mechanic who did the work, and from the, from Audi for the software that was used, and from the dealership that owned the facility where the work was done. Do you get 500 bills? No. I mean, it's really amazing that in this industry, there's 20% of GDP that one simple function of billing is such a mess for the consumer. So I think there's so many basics that need to be addressed that we've got a lot of innovating and mind power and thinking to do just to tackle these individual solutions. And then I think in terms of tying things together, I don't think it'll be a whole lot different than we see in other industries. I think the underlying technologies continue to progress and talk to each other and get more friendly and become more ubiquitous in terms of the underlying data structures and the underlying information that is interactive.
I'll add one thing to that too, just from my purview of looking at software across all areas of the economy. There's never an end game, meaning there's not going to be one winner, one EMR to rule all of them. It's going to be a long journey, fraught with winners and losers, and we've seen in healthcare pockets emerge with themes. This idea of democratization, themes like population health management, performance-based outcomes, Internet of Things, data connectivity, patient engagement. There are a bunch of these areas. Wellness is another one. And there are going to be startups that are popping up and addressing each one of these areas. And the larger incumbent EMR systems are going to be scrambling to go and acquire them and try to get the best-in-class functionality in each of these areas. And it's going to be a long, long journey. And I think if you can develop something that's truly different, the market is plenty big enough. We all know that. But since, if you can develop something that's truly differentiated from a product perspective, then you could do quite well. There are plenty of buyers out there.
I think we have time for one more question. I think we're
just beginning to collect data, and artificial intelligence is mainly data-driven. So in terms of innovation and automation, that's one question. And what are the kind of investments that are being made in artificial intelligence used in healthcare?
Yeah, that's a good question. There are a lot of new companies that are, you hear about big data, machine learning, predictive analytics, and AI, and there's a lot going on in healthcare. I met with a company a couple weeks ago called Cognitive Scale, and it's all the former folks coming out of IBM Watson that are starting this new learning engine, and one of the main use cases is in healthcare, and it's the idea of how do we provide better patient care. So when the doctor goes in to interact with the patient, he's armed with all the data. Where do they live? What's the pollen count over here? Tie that into the EMR. Tie that into the wealth of data that is across all regions of the U.S. for that condition, and what's worked, what hasn't worked. There's a lot of data, and I think everyone's trying to get better at machine learning and improvement via analytics over time. But where companies are struggling today is they get it up to the predictive analytics, which means they can start predicting what will happen and modeling that out and simulating different scenarios. But we haven't seen any companies yet that have cracked the code around prescriptive analytics. And that's the next frontier. And what I mean by prescriptive analytics is actually telling the doctor what to do. So now that we've taken all the data, we've analyzed it, modeled out how the probability of outcomes, now what should the doctor actually do? There haven't been that many companies I've seen that have done that today, but I think that'll change. To answer your question, there is a ton of investment going into that area.
Yeah, the only thing I would add to that is I think the folks that are looking at that sort of like maybe artificial intelligence or metadata that I've run across are like selling into the insurance companies or some of the larger businesses in the broader healthcare space that kind of operate off of data and want to figure out how to manage costs, et cetera, by having access to that data and iterating on it at a more macro level. The one place I have run across artificial intelligence personally is outside of the healthcare industry. I do have a data analytics business, and we manage regulatory and legislative data. It's kind of scary. We actually maintain the body of congressional law for Congress. Back to my earlier comment, you would think that would be a core expertise for the government to maintain their own law, but at any rate, so we maintain the database of congressional law, and then since it's publicly available, we then sell that through to the public. And what we've done with our database is we've wrapped it with a machine learning capability, and then that enables us when consumers want to interact through a Bloomberg terminal with our, I guess Bloomberg terminal is a stale term now because I don't really have terminals anymore, but when they want to interact through their computer interface with Bloomberg to look at legislative data, what we do is we understand in an iterative fashion what type of data is that person searching for. So if you are a lobbyist and you are trying to learn about agricultural legislation, and a bill comes out in another field that's going to impact agricultural legislation, what you can do is we understand that you're trying to learn specifically about agricultural legislation. So as opposed to pushing you every single type of data and law and every single legal change that might be relevant to you, we specifically push you the data about agricultural legislation. And we have the broader database to see other areas of law that you wouldn't realize are going to affect the area of your interest. So over time, that database gets more intelligent. So that's the closest thing I think that I've encountered to AI.
Well, I think we've run out of time, but thanks a lot, guys. Chris and Harrison, really appreciate it. And again, these guys may stick around for a couple of minutes, so if you haven't asked your questions, then feel free to follow up. Thanks a lot.